Hello everyone, I'm Jelly and I'll be presenting topics under cost of capital. The objectives of this presentation is to describe the factors that affect weighted average cost of capital or WACC, explain how to adjust cost of capital for risk, and identify some problems with cost of capital estimates. Now, there are several factors that can affect WACC, and some of these factors are beyond a company's control, but others are influenced by the company's financing and investment decisions. The two main factors that a company cannot control are interest rates and tax rates. Now, if interest rates go up, the cost of debt increases because the company will have to pay more when it borrows. So, to illustrate, for example, if a company wants to borrow 10 million pesos to build a new factory and the interest rate is 5%, the company has to pay 500,000 a year in interest. If the interest rate increases to 8%, the company now has to pay 800,000 yearly. So that extra cost will increase WACC. And there's a rule in investing, high risk, high returns, low risk, low returns. So if interest rates go up, the investment becomes riskier. Hence, the investors would expect higher returns, which will increase the cost of equity. Now, for the tax rates, if tax rates go up, the effect on WACC is a bit mixed. First is cost of debt can go down slightly after taxes because interest payments are tax deductible, and a higher tax rate means a bigger deduction, lowering the after-tax cost of borrowing. Second is the cost of equity might go up if higher taxes make stock returns less attractive to investors, so they demand higher returns to compensate. For example, if a company borrows 10 million at a 10% interest rate and the tax rate is 20%, the after-tax cost of debt becomes 10% times 1 minus 0.20 is equal to 8%. And if the tax rate increases to 30%, the after-tax cost of debt becomes 7%. So the after-tax cost of debt decreases when the tax rate increases. However, if taxes go up, investors would keep less of the profit they earn from owning shares. So in order to achieve the same after-tax return they want, they would demand a higher pre-tax return from the company. So to illustrate, suppose an investor wants to keep 8% after taxes. So as shown here on the table, if tax rate is 20% and the after-tax target is 8%, the pre-tax return needed is 8% divided by 1 minus 0.20 is equal to 10%, which would be the cost of equity. And if the tax rate increases to 30%, the pre-tax return needed becomes 11.43%, which is the cost of equity. So higher pre-tax returns required by investors result in a higher cost of equity for the company. And the overall change in WACC depends on the balance between debt and equity effects. Now, here's a table showing how interest rates and tax rates can affect a company's WACC. So we assume that the company's capital structure is 50% debt and 50% equity, and its before tax cost of debt is 10%. The cost of equity is 12% and the initial tax rate is 20%. So in the base case scenario, the interest rate is the given 10% and the tax rate is the given 20%. So the after-tax cost of debt would be 10% times 1 minus 0.20 is equal to 8%. And the cost of equity is the given 12%. So if we compute the WACC, it is 0.5 times 8% plus 0.5 times 12% is equal to 10%. Now, if the interest rates increases to 12% and the tax rate is the same, 20%, the after-tax cost of debt would be would become 9.6% and the cost of equity would also increase to 13%. So the cost of equity is assumed to increase when interest rates or tax rates increase because investors demand higher returns to compensate for opportunity costs or reduce after-tax income. Now the WACC would also increase to 11.3%. Now, if tax rates increases to 30% and the interest rate is the same, the after-tax cost of debt would now become 7%, so it's lower. However, the cost of equity increased because investors demand higher returns to compensate the reduced after-tax income, and the WACC becomes 10%. Now, if both interest rate and tax rate increases, so we have 12% for interest rate and 30% for tax rate, the after-tax cost of debt is 8.4%, and the cost of equity increases to 14%. And now the WACC becomes 11.2%. Now, for the other factors that affect WACC, we have capital structure, dividend payout, and capital budgeting decision rules, which are controlled by the company. The capital structure is a mix of debt and equity a company uses. More debt can lower costs because it's cheaper than equity, but can also make the business riskier. This can raise both the cost of debt and equity, possibly canceling out the benefit. For the dividend payout, paying out more dividends means keeping less profit for investment, which can lead to selling new shares and raising the cost of equity and WACC. However, cutting dividends might upset investors and make them demand higher returns. Now, for the capital budgeting decision rules, WACC is based on the risk of the company's current assets. So, if new projects are riskier than usual, the cost of debt and equity will rise, pushing WACC up. For example, Company X makes and sells bottled water, which is a low risk business, and Company X considers investing in a cryptocurrency mining operation. Crypto is much riskier and more volatile than bottled water production. Hence, investors would demand higher returns to cover this extra risk. Now, let's understand how to adjust the cost of capital for risk. The cost of capital is the hurdle rate a project's returns must beat to create value. Riskier projects need a higher hurdle rate, and safer projects need a lower one. Using the wrong hurdle rate can lead to poor investment decisions. If a company doesn't adjust for risk, it might accept too many risky projects or reject good, safe ones, which can hurt long term performance. A company's overall WACC applies only to typical projects with the same risk as its current operations. For projects with different risk, the hurdle rate should be adjusted up or down. So let's look at this figure. And here there are two firms, Firm L and H. Firm L is a low risk business and it has a WACC of 8%, while Firm H is a high risk business with a WACC of 12%. Both firms are considering projects A and B. And Project A's risk is average and has an expected return of 10.5%, and its project specific WACC is 10%. Both firms should accept Project A because its expected return is greater than its project specific WACC. So 10.5% is greater than 10%. Now for Project B, it has the same risk as Project A and it has an expected return of 9.5%. Both firms should reject Project B because its expected return is less than its project specific WACC. 9.5% is less than 10%. Note that we do not compare the project's expected return to the company's average WACC. Because if we do that, if for example we compare the expected return of project A to firm H WACC, then firm H would have to reject project A because its expected return is less than its WACC. 10.5% is less than 12%, and that would be a wrong decision. Now, for multi-divisional firms, a company with divisions of different risk levels shouldn't use the same corporate WACC for all divisions. So let's look at this figure. Here we have a firm with two divisions, Division L and Division H. Division L has a WACC of 7% and is considered low risk. And then Division H has a WACC of 13% and is considered high risk. And then the corporate WACC is 10%. Both divisions are considering a project. Division L is considering a project with an expected return of 9%, and Division L should accept this project because its expected return is greater than the division's WACC. 9% is greater than 7%. For Division H, it is considering a project with an expected return of 11%. And Division 8 should reject this project because its expected return is less than its WACC. 11% is less than 13%. Now, if corporate WACC were used for both projects, Division L would wrongly reject its project, while Division H would wrongly accept, leading to higher overall risk and a rising WACC over time. To make good investment decisions, companies must adjust their cost of capital to match the specific risk of each project or division. Failing to do so can cause them to take on too many risky projects and miss safe, profitable ones, reducing shareholder value in the long run. Next, let's identify some problems with the cost of capital estimates. First is the depreciation generated funds. These are a major funding source and their cost is roughly the same as the WACC from other financing sources. Second is the privately owned firms. Same cost of capital principles apply. However, it's harder to measure their cost of equity since they're not on the stock market. Third is the measurement problems. It's difficult to get accurate inputs for, say, CAPM, dividend growth, or risk premium methods used to compute cost of equity. Hence, we can never be sure just how accurate our estimated cost of capital is. Fourth, the different risks for different projects. Risk measurement and proper adjustment are challenging in practice, and it's hard to precisely measure risk and adjust costs for it. Lastly, capital structure weights. Deciding the right debt or equity mix is a complex task on its own. Despite the challenges in estimating the cost of capital, current methods are still reliable for practical use. These problems listed here highlight areas for improvement but do not invalidate the usefulness of the procedures used to estimate the cost of capital.